Hello everybody, my name is Zach Hartley, and in this video we are going to do a full stock review of the number 2 fastest growing company in all of Canada. And if you've been watching my channel for a while, you will know that I used to talk about this company. It was formerly Drone Delivery Canada, and recently they merged with Volatus Aerospace, keeping the name Volatus Aerospace and keeping the ticker from Drone Delivery Canada. And in 2024, they were ranked as the number 2 top growing company in 2024 with a 3-year revenue growth of 17,336%, which is absolutely mind-boggling, especially after what you are about to see in this video. So let's dive into it. The company we're talking about is Volatus Aerospace, formerly 2 separate companies, Volatus and Drone Delivery Canada, recently merged in 2024. The ticker symbol is SFLT. They kept the ticker symbol from Drone Delivery Canada, and they trade on the Venture Exchange here in Canada. They are headquartered in Toronto. The price, as I film this video, is roughly 13 to 14 cents, giving them a market cap of roughly $63 million. This is their logo. This is their website. I am not a financial advisor. This is just my opinion. Some of the information might be wrong. Take it with a grain of salt. If you are angry about this video, then leave a comment and let me know about it, and let me know if I'm wrong about anything. That's probably the best place to start. The business model at Volatus is pretty simple. They are a comprehensive solution provider that uses both piloted and remotely piloted aircraft systems. They serve industries such as the oil and gas, utilities, healthcare, and public safety. They are a drone company that is trying to utilize drones to serve these industries. And when you look at their stock chart, it is not doing so well. So this is the stock chart since they merged. As you can see, it hit a high of 24 cents, a low of 11 cents, bounced back up to around 22, 23 cents, and now it's trading around 13, 14 cents. Basically pulled back a little bit and hasn't really rallied with the rest of the market. And when you look at either of the stock charts over the last few years, neither of them are looking very good. Both of them had a bit of a run up in early 2020, 2021 kind of area, and since then they've basically been falling pretty much in the same direction. And so from a technical standpoint, not a super attractive chart. We might have a little bit of support right here around 11 cents, but we're currently trading in a long-term and short-term bearish direction. Now, the balance sheet is really what I want to focus on here, because this is a company that it's going to take a while for them to really achieve what they want to achieve, but the balance sheet is really going to be either the key to success or the key to failure. And right now, it looks like a failure point, and let me explain why I say that. So this balance sheet ended December 31st, 2024. We're already in May of 2025. So this just got released a few weeks ago, and honestly, it feels like a little bit of old news, but there's a couple of things I want to point out. Number one, they only had $1.5 million worth of cash at the time. They have since raised money by issuing shares, so the cash position is a little bit higher than it looks like on this balance sheet here, but they had to issue shares in order to do that, so shareholders took a bit of dilution. They also have $13.5 million worth of intangible assets. Those are assets that they're never going to be able to realize on and that nobody else is going to buy from them. They also have $20.7 million of goodwill. And so basically $34 million of their $45 million in assets is intangible goodwill that nobody's going to buy, and they're never going to realize. Eventually, they're just going to have to write it off. So something to keep in mind there. The $45 million that they're showing on their balance sheet, I don't have a whole lot of, it's not like they can liquidate that and realize $45 million. They're a little bit limited there. Now, when we go to the liabilities here, they have $6 million in trade payables and accrued liabilities. They have 4 times the short-term just accounts payable than they do cash on hand. So not a great sign there when this balance sheet was taken. They also have $9 million of the current portion of long-term debt, and they have $20 million of current liabilities. They only have $11.9 million of total current assets, and so their current ratio looks absolutely terrible. They have a lot more liabilities than they do in assets that are due or realizable in the next 12 months. Not a great sign of the health of the company. Long-term debt. When we look at the actual long-term debt, they have $11 million that they owe, and so their total current assets is pretty much equal to their total current long-term debt. or total long-term debt, not current debt, I should say. But again, like, not the end of the world here, but I would call this a significant debt burden for the amount of assets that the company has and the amount of revenue that they are bringing in. I would not say that this is a super strong or healthy financial position. They have a significant amount of debt that they're going to be paying interest on that we're going to talk about in just 1 minute here. And they have a $32 million deficit. So they've lost $32 million since they started. Obviously, there's a couple different companies in there and a lot of financing and a lot of accounting there, but they haven't made money yet. They've lost a lot of money, and that's the starting point for evaluating this company. Now, when we go to the income statement here, this is where it really starts to get interesting, because the first thing that you always look at is revenue increasing or is revenue decreasing? And unfortunately, from 2023 to 2024, revenue decreased pretty substantially by the tune of like $8 or $9 million here. It was pretty substantial. So that had a major impact on everything else. Their gross profit declined in 2024 compared to 2023. The gross profit margin, the percentage of gross profit that they generate on revenue, did increase slightly, which is good to see that maybe they're concentrating on higher margin avenues a little bit more. But overall, revenue is down significantly, gross profit is down significantly, and expenses actually went up by $240,000 roughly. And so they are struggling. They are not anywhere closer to break even or making profit. They're actually further away in 2024 than they were in 2023. So not a great sign there. And then the debt. I just talked about the debt on the balance sheet, and this is where it is showing up. The financing cost right here. This is basically all interest that they're paying on their debt. It is now at almost $3 million in the year of 2024, and it's probably going to be well over $3, if not $4 million in the year of 2025. And so this is crucial. This is weighing them down, and it is having a significant impact on their profitability, even though they're nowhere close to profitable at the moment. Now, this is just the yearly summary. When we take a look at the quarterly summary, ideally, what we would like to see is that Q3 was better than Q2 and Q4 was better than Q3, and things are getting better. But unfortunately, the loss from operations was $2.1 million in the last quarter. It was basically $2 million in the quarter before that, most likely because of the merger that they went through, and it was 1.9 in the quarter before that. So they're actually losing more money as the quarters are going on, and it's not looking there's no clean directory or trajectory to profitability for this company. Like, the loss from operations is not getting better as time goes on. And so that is a pretty major concern, and they're losing roughly $2 million per year. Now, when it comes to that financing cost, here is what it looks like, and here's what that $2.9 million is made up of in 2024. It's basically all interest except for $81,000 in bank charges. So other than $81K in bank fees, everything else of this $2.9 million is interest that they're paying on the debt from basically that they needed to operate. Now, these financials are dated for the end of 2024, and since then, they've done a lot of news. They've done a lot of financing events. There's a lot going on since then. This company tends to release an absolute ton of news releases. None of them seem to make a huge difference so far, but they do seem to be there. What you may want to consider and may want to look at, though, especially if you're currently a shareholder, is that since these finances were concluded, so January 1st of 2025 up until today, they have been consistently diluting shareholders. Just as an example, January 2nd, company converted $80,000 of non-redeemable preference shares into common equity by issuing 2/3 shares. Next one, they issued 2.1 million shares. Next one, they issued 1.1 million shares. Next one, they issued 20 million shares and 17 million warrants. So, like, this company is issuing shares in order to raise money to stay alive and to pay off debt. That is the position that they are in right now. And since 2025, they have issued a lot of shares. Now, I didn't do the math on it. I actually just sent the annual report into Grok and said, hey, how much has this company diluted since the beginning of the year? If you count just the shares, they've diluted shareholders by 10.48%. And if you include the warrants that are issued with those shares, it works out to 19.58%. This data is coming from Grok. You can verify it for yourself or do the math yourself. But they're issuing shares, and your percentage of the company, if you own shares right now, is declining because they need to issue those shares to bring in money to stay alive, which is not a good position to be in. if you're trying to build a business. In recent news, though, they just raised another $3 million, again, by issuing shares. On May 14th, they paid off $3 million in debt by issuing shares. And then they have announced a lot of partnerships since the beginning of the year and over the last few months. So hopefully some of those partnerships really start to turn into revenue and really start to hit the income statement and help out the balance sheet. They also obtained some approvals here. So like there are good things happening, but like they might be pushing a boulder up a hill right now, and I'm a little bit worried about it. If we take a look at what it would cost for this company to break even, they're making roughly 35% gross profit on the revenue that they bring in. They're currently losing roughly $10 million a year. That means that revenue would need to jump by $28 million just to break even. That means that they basically need to double their revenue just to get to the point that they're not losing money, which is a tough thing to do. Plus you have all the debt and the interest on top of that. So like they really, really need to kick things into high gear and get that revenue number way, way up if they have any chance of making it without needing to just keep consistently raise money. So in summary, here are my thoughts. I know it's not great. If you think I'm wrong about anything, please leave a comment. Happy to correct myself here, but my opinion is that this is a pretty weak financial position, even with the money that they just raised. Like they're going to have to keep raising money because as of right now, there's no path to profitability. Their income statement is fairly poor. Revenue is declining, gross profit is declining, expenses are not declining, and interest is piling up. So I have a lot of concerns there. They're also significantly diluting current shareholders in order to pay off debt and bring in cash. The technicals of the stock chart don't look very good, and as of right now, I don't see like a trajectory or a path to profitability. So I've got some pretty major concerns. And so based on my last video that I made 5 or 6 months about this company, I pretty much stand behind everything I say, and it feels like I was sort of right about things so far. Now, hopefully, for the sake of the company, for the sake of the employees, for the sake of the drone industry, for the sake of Canada, I am wrong. Hopefully, these guys turn it around, revenue skyrockets, and they really do well over the next few years. That is what I hope. But as of right now, I am not buying the stock. I'm staying away from it with a 10-foot pole, and it's going to take a big turnaround for me to get back in, even though it's a slightly different company now. So those are my thoughts. If you guys got any value out of this, please remember to click that like and subscribe button. I'm sorry this wasn't a positive video, but I figured it was time to do an update. So that's it. Thanks so much.